morning and welcome to the Shenkman Private Client Group Accountant Attorney Spring Webinar Series. This program is entitled New York Tax Update Post-COVID-19. For those who don't know me, my name is Jonathan Shenkman, and I'm a financial advisor, portfolio manager, and an accredited investment fiduciary at Oppenheimer based in New York City. The goal of all my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning, and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 25 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in Barron's, CNBC, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, and many other periodicals. After the program, I'll send out a link to all the publications where I publish my work. One quick note before I introduce our esteemed speaker, which is the handout to this program were sent out within the reminder email yesterday morning and this morning as well. It will also be sent out again in the follow-up email to this program tomorrow morning. Today, we're privileged to hear from Timothy Noonan, who's a partner at Hodgson Russ based in New York. Tim focuses his practice in the state and local tax area. His work primarily involves New York State, and New York City tax litigation and controversy. Over the past 20 years, he has handled more than 1,500 personal income tax, sales tax, corporate tax, and other New York tax audits. Tim also has handled about 100 cases in New York's Division of Tax Appeals. Tim leads the firm's tax residency practice, and he's one of the leading practitioners in this area of the law. He has handled some of the most high-profile residency cases in New York over the past decade, including a 2014 win in the Gaeta case, one of the first New York residency cases to ever reach New York's highest court. Tim also co-authored the 2018 edition of CCH Residency and Allocation Audit Handbook and Contesting New York State Tax Assessments. He's often quoted by media outlets, including the Wall Street Journal, New York Times, and Forbes on residency and other state tax issues. Tim is a nationally recognized author and speaker on state tax issues and is a member of the advisory board of Tax Analysts State Tax Notes. Today, Tim will be speaking on New York Tax Update post-COVID-19. And with that introduction, I'll now turn the program over to Tim.
All right. Thanks, Jonathan. It's great to be back here with everybody. It's been, I have pretty vivid memories of doing this with Jonathan 2 years ago. Same time of year, like at the end of April, we're all probably planning on getting back in the office. April 2020, we'll be back in the office in a couple of weeks. But it was one of my first webinars that I did when COVID hit. And of course, I think I've done about 384 of them since then, but still, of course, getting used to the drill of the webinars and sharing my screen and whatnot. So hopefully I don't screw that up. But nice to be here again today. This topic, Jonathan and I were just talking, like the issues that arise but in the individual tax realm around state taxes in New York in particular over the past 2 years have just been amazing. Like all of the issues that come up around people moving, people telecommuting, New York State getting super aggressive. It's been obviously a tough couple of years for everybody, but from a sort of practice perspective, it's been exciting. I mean, there's just been a lot going on. Also exciting is I don't have to chase myself to New York City a couple times a week. That's been nicer. We're mostly working in the office now, and this is my home background today, just because I had some stuff to take care of around the home front. But it's nice to sort of be back in the office. I know that in the city it's still a little slow to that, but again, all of these issues about working from home and where people are living. That's the centerpiece of a lot of the state and local tax issues that arise in my practice around residency and personal income tax issues. So got a real short program today. Really, it's just quick hitters on what's happening in the New York tax world, particularly around individuals. I want to talk real quickly about a couple things that happened in New York's budget a couple weeks ago. And then just give a quick sort of post-COVID related residency and telecommuting update, just to kind of give you guys a sense and sort of an update as to what's going on. As Jonathan said, you guys got all the materials. that I'm going to be talking through today. As is always the case, if you have questions after this, feel free to send me an email or give me a call. Happy to spend a couple minutes with folks if they have questions. All right, so the budget. So not a ton of stuff. I mean, the biggest news in the budget, as you know, is you guys all just agreed to pay for my football team stadium in Buffalo. So thank you for that. That was nice. But from a income tax perspective, not a ton of stuff, but one sort of cool thing. So the PTET, which is potentially the bane of all of our my accounting friend existence, but it's been obviously it's a great program to save us New Yorkers some federal taxes, but it's kind of a mess. But one of the sort of interesting sort of legal issues that arose is when they passed this last year. If I was an S corporation shareholder, I wasn't able to get the full benefit of this, depending on the type of my business, because the rule said, well, if you're an S corporation, you only pay the PTET, the entity tax, based on the sourced income of the S corporation. Well, that could be a problem if I own an S corporation, I sell sneakers and most of my customers are outside New York. Well, my PTET tax liability was low. And again, in a sort of odd twist here, we want the tax to be higher, right? Because we want to get the federal deduction. But my PTET was low because I could only pay the PTET on my sourced income. The reason they did that was sort of a paternalistic thing. Like the state thought that if you had a situation where there were resident owners and non-resident owners of my S corporation, then the problem would be I would get more of the credit or the deduction for the PTET than my non-resident shareholder. And the state thought, geez, maybe that could screw up your S election. Okay, fine. So they just said, we're going to protect you all from doing that. Only pay tax on sourced income. The problem was there's a heck of a lot of S corporations out there that don't have any non-resident shareholders, right? We're all residents, right? So, or it's a 100% owned S corporation. They don't care about this S election issue. So we actually went to the Business Council of New York was a part of this to say, hey guys, can you fix that? Like if you're a 100% owned S corporation, why can't you get the full benefit of the PTET? And to its credit, the legislature and the tax department, I think, said, yeah, you're right. So they fixed that, and they fixed it retroactive to 2022. So if you're a resident only or 100% resident owned S corporation, and you've elected into this PTET, obviously, then you're good. You can pay tax on 100% of the income. They'll be required. This year, it'll be required when you file to make some sort of certification that everybody's a resident. I think next year you have to make that certification when you make the election. But in any case, pretty cool. Also pretty cool, the city is going to have its own PTET. From what we can tell from the legislation, that's not going to be effective until 2023. I heard rumblings that there may be some folks trying to see if we could get that effective, this year. I don't know that that's going to happen, but New York City PTET. So for New York City residents, they also stand to benefit from this next year. And for all of all the accountants out there, more fun, right? Because that's presumably more tax returns, more elections that have to be made, more tax returns have to be filed. So good news, sort of, but it's going to be complicated. Okay, so and lastly, if you want to see the other stuff in the budget, we've kind of blogged about it. We got a posting on our website. The link is there. So feel free to check that out. Again, not a ton of other super interests. There's some stuff on credits and incentives, brownfield credits, but no change. They're not raising the tax rates again. Nothing like that. Okay. So residency stuff. So again, what's been happening in New York over a couple of years is obviously COVID happens. That causes lots of people to flee. Permanently, maybe temporarily, lots of people. And around the same period of time in last spring, the state in its infinite wisdom decided to raise tax rates, because why not? When everyone's leaving the state, what's the best way to bring people back? To raise tax rates. So the tax rates went up, the individual income tax rates went up. So, and those are a confluence of things, right, that causes now taxpayers to flee. You could date it back to 2018 when the SALT deduction went away or was capped. That caused a lot of movement. COVID obviously happens, and that the reverberations there are still happening. I still take many calls a week of people who are thinking of moving, who want to move, who just moved last year and need some help. So that continues to happen. The tax rates going up didn't help. It didn't help at all. Even some of the fears around the federal taxes going up. People say, well, if the federal taxes go up, I can't have my effective tax rate in total to be more than this 50% or whatever. So I got to move to Florida to cut off. If my Fed tax is going up, I got to cut off my state tax. So all of these things are sort of causing people to leave. And it's a huge issue. I don't, for the long-term viability of our state, I hope we're okay. But, I represent people who are, living in New York or moved from New York. I worry that I'm going to run out of clients with everybody moving. But the good news is, for me, they're all going to get audited, right? So there's been an explosion of audits already for 2020. And the other thing we have going on with this is, are people coming back, and how does that impact their tax liability? Here's an example. Very typical example here, where you have taxpayers who lived in the city, worked in the city, but they went to the Hamptons when COVID hit. Their kids did a couple of years in the Hamptons, didn't really spend a lot of time in the city, but in the fall they're going to come back, right? They call me up and say, Tim, the Hamptons was good, school was okay, but looks like COVID's kind of over, and we want to get our kids back in the school they were in, so we're going to come back. So the issue is, well, what's the New York Tax Department going to say about that? In order to change your domicile, right, the domicile test is the primary test in this residency area. You got to do two things. You have to leave New York, in this case, New York City, with the intention of not coming back. And you have to land in the new place with the intention of living there permanently, or at least indefinitely. So if you have a situation where someone sort of was a COVID refugee and they left with the intention of coming back, well, they didn't change their domicile, even if they only spent 70 days in New York City, even if their kids were in school in the Hamptons or wherever they went. If you come back using 2020 hindsight, the question is, well, did you ever was that a real move, or was that just sort of a COVID refugee thing? So, for folks who are doing that now, what we try to do, again, there's 2020 hindsight out there. If you came back, the state's going to say you never intended to leave. The city's going to say that in this case, but you could build up a narrative now that no, we really intended to move. We didn't intend to come back. We never thought we'd be back, but X, Y, or Z thing happened, or there was some issue with the kid's school or some job issue that we had to change our mind, right? Your life happens, you're allowed to change your mind. So you need to sort of have that reasoning. You can't just say, well, shoot, I wasn't in the city all that much in 2021. I was in the Hamptons, so you can't tax me. And that, the domicile test, the leave and land test can be a little funkier. Here's another spin on that. Again, another issue that we've been seeing in this context over the past couple of years. Same exact example as the other case with someone fleeing COVID. These guys, though, they didn't really intend to make the move permanent. They really were just fleeing to their vacation home for what they thought was a couple months. Funny story, it turned out to be a couple of years. But so they were in Connecticut, and they were in Connecticut. Kids were maybe Zoom schooling or remote schooling to New York City. But they didn't get rid of their city place. They definitely were coming back. And indeed, they're coming back now. Here's the issue there. So they're still New York City residents, New York State residents, New York City residents. Why? Well, because of that leave and land issue, right? They didn't intend to land in Connecticut or leave New York. They were just sort of, hiding out for a little period of time. So New York's still going to grab them. Connecticut, well, they didn't land in Connecticut, so they can't be a resident, right? Well, Connecticut has got this alternative residency test, just like New York does, that says, well, if your domicile is somewhere else, but you spend more than 183 days in our state and you have a place of abode in our state, well, you're a resident anyway. You'll be a resident of two states in that instance. In almost all the cases I dealt with in my 20 plus years of practice, that happened the other way. Someone lives in Connecticut, works in New York City, has an apartment in New York City. There's potential double tax there because their domicile is in Connecticut and they're a resident, what's called statutory resident of New York City because of that 183-day rule. That's been creating potential double tax issues for years. I litigated a couple cases all the way up to New York's highest court on that issue. That those cases are not in the bio that Jonathan read for you because I didn't win. I won the other one, so I keep that one in the bio. But whatever. I mean, we litigated 2 cases just pre-COVID. It seems like 20 years ago, but it was actually 2018, 2019. Where we tried to say that double taxation is unconstitutional, again, for someone who lived in Connecticut, but was a statutory resident of New York. In any case, this is the opposite of that. Someone lives in New York City, but are they a statutory resident of Connecticut because of the 183-day rule? So it's interesting. Connecticut's approach here, what I had sort of heard that what they were thinking was that for 2020, they get it. Like no one really knew this was going to be a long-term thing. A lot of people were hiding out. Like they're going to take a soft approach to 2020 and not ding people for this 183-day rule in 2020. But in 2021, you should have known better, like at this point. So the risk is out there for folks on the double taxation. I think there's arguments that perhaps you don't qualify as a statutory resident of Connecticut, that maybe your place of abode there, it's got to be a permanent place of abode. Maybe you can argue it wasn't a permanent place of abode. So potentially there's arguments there. What's also interesting is that Connecticut ran an amnesty program last year, between November of 2021 and January of 2022. And as part of that, they sent out a bunch of letters to people, including people who were on the Fairfield County tax rolls as having a New York address and owning property in Fairfield County. And it was just a kind of friendly letter that said, hey, just so you know, we're running an amnesty program. Also, just so you know, there's this statutory residency rule, right? That if you live in New York, but you have a place in Connecticut and you spend more than 183 days in Connecticut, you could be a resident. So just wanted to let you know, have a nice day. So these letters went out to folks. And for some people said, oh, okay, I guess I'll take advantage of the amnesty program, pay my tax. There was, a huge break in the interest, although for 2020 taxes, there wouldn't have been a lot of interest, but whatever, no penalties. But others didn't. And, the question is Connecticut now going to follow up with those folks and say, hey, remember that letter we sent you about, statutory residency? Well, here's an audit notice, right? So that could happen. And again, there's so many issues like that arose as a result of people running around due to COVID. The more typical, not say more typical, but the more common situation is someone going to Florida. In fact, I at times I felt like I should have just changed my voicemail to, hi, I'm Tim Noonan. I'm not in the office. Press 1 if you're moving to Florida. Press 2 if you're moving to Connecticut. And then I could just sort of, it would be a lot easier. But because there's just so many people, I can't even count the number of times I got a call that said, Tim, since March of 2020, we've been in Florida. We think we want to stay there. We got a house there, or we can't buy a house there because it's too expensive. Everyone's buying a house, but we're renting. What do we do? So this, typical example here is a family moves down to Florida, kind of staggers the move. The wife moves down first in July, spouse joins with the kids in September. It's really a move. Like they got rid of their place in New York. They're living in Florida, kids in school, like they really decided to move. A couple of things here. So one, what we'll see on these audits, and particularly, I think the movement of the hedge fund industry down to Miami has been massive. So what a lot of these hedge fund folks will have in 2020 is an issue because they were residents for part of the year, non-residents for the last part of the year. They have all this income during the year, management fee income, but also carried interest, incentive allocations, that type of thing. And the position that I think is the right position is that, well, that's earned as of the end of the year, right? That income crystallizes on 12/31. So if someone moved like these guys in July or September, and they have $10 million of carried interest that's in their 2020 tax return, well, we're going to say, no, New York doesn't get any of that because that's all earned on December 31st, 2020. So we can expect those issues to pop up in the context of a lot of these audits. And make no mistake, there's going to be a lot of audits. What we're seeing here, and this is a little screenshot of the letters that you all have probably seen numerous times for your clients, is these sort of desk audit letters that go out right away. these letters. And this one, if you even look at, it's funny, the date of the notice is March 23rd, 2021. So it's last year. They want information about the 2020 tax filing. So this probably came out like a week after the tax return was filed. So what happened is New York, recognizing that lots of people moved, also recognizing that lots of people, lots of non-residents already, people who lived in Connecticut or Jersey or somewhere else, who used to work in New York are now telecommuting and might have tried to reduce their taxes as a result. We'll talk about that in a second. And again, or someone who moved to Florida is now telecommuting. Like they knew all these people were moving, right? They probably were listening to our webinars. And so they had to figure out a way to deal with it. And one of the ways they've dealt with it is through this like triage desk audit program. Like, so this is if you look at the top left-hand corner of this, it's from the income franchise desk unit. Desk audits as opposed to field audits, which is the typical way the field auditors usually do residency audits. So they'll come in, they'll, there used to be meetings, but now it's Zooms and sending documents and stuff, but it's a detailed audit, lots of IDRs, experienced auditors who do these cases for a living. These desk audits are not that. They're kind of quick hitters. All pretty much the same boilerplate questions, no human being really. I mean, there is a human being somewhere, but no human being often for you to deal with. And it's been super haphazard. So we saw hundreds of these. I heard that 100,000 or so of these went out for 2020 filers, and in all shapes and sizes, right? They didn't seem to discriminate income amounts either, which was annoying. But I guess what I'm seeing them for 2021 now too. Like we're already seeing folks who file early in 2021 getting these things right away. So it's frustrating because it's been a little haphazard. They're not, not the typical audits. They're not understanding nuanced issues around residency and income allocation. So it's been a struggle. Sometimes they just won't give back the refund, and we're going to have to fight them. We have to take cases to the Division of Tax Appeals because of these sort of, pardon my French, but half-assed audits, right? You're just, we're sort of in a tough spot. So, with respect to this, again, just a couple big picture points on all of these moves. So many people have moved, in our own practice, that aspect of just helping people move. I should have started a moving company, t-shirts, the whole thing, there's so many people moved. How is New York going to get to everybody? Right. I used to tell folks that, well, if you make under, $500,000, maybe you probably won't get audited. Even under $1 million, like you probably won't get audited, but above $1 million, it's a guaranteed audit. I wonder if that threshold is going to have to go up, that because so many people move, they just can't get to everybody, that maybe the threshold is 2 million. I don't know. I mean, it's always been more art than science, but I just don't know how they can chase everybody. The desk audit program that I just talked about is one way to try to do that. Again, like I said, that's imperfect. So whether or not they can chase everybody who moved is going to be an issue, since there's been so much movement. And when these audits start, look, the field audits, and again, we're seeing field audits of 2020 now too. And again, it's sort of interesting. I wonder, with these desk audits and with the field audits that have started already, in some cases, it's kind of early, right? The auditors might want to see, the time patterns, because of the issue I mentioned a few minutes ago about leaving and landing. Like, was it a permanent move? So in a 2020 audit, one of the things I know they're going to ask about is, well, what does 2021 look like? You might be like, well, I didn't file that return yet. You can't audit that return. I know, but the auditor is going to say, under the residency rules, was the move permanent, or was this just a COVID refugee thing? So they're going to want to see your 2021 time patterns. They're probably going to want to see your client's 2022 time patterns. So that's going to be important. And the other thing that will be interesting is, in 2020, a lot of people have like great time patterns, right? I didn't spend barely any time in New York. I should win, right? Usually if you spend a hell of a lot of time in Florida and not a lot of time in New York, it's a recipe for a great case. But I think New York's going to say, you're not going to get any special brownie points for a great time factor in 2020, because no one was here, right? Everyone left. Let's, see what 2021 looks like. And oh, by the way, in 2021, not a lot of people were here either, right? So what does 2022 look like when COVID was really over, I think, so the audits will be interesting. The audits will be numerous. Folks like us who do this kind of thing are going to be busy. So the other shoe to drop here is remote work. So just to sort of wrap up with a couple points on remote work. So look, the issue here is if I'm a New York resident, I pay tax on all of my salary, all my compensation, that's easy. If I'm a non-resident, then I only pay tax on the days I work in New York, right? But what's a work day? Well, obviously, if I come into New York, meet with a client, something like that, that's a work day. But telecommuting, not so easy. If someone's telecommuting from their home in New Jersey or Connecticut or Florida, and they're a non-resident of New York, but they're working from home for their New York-based employer, New York says, well, we have a convenience rule. And historically, only a handful of states had a convenience rule, New York sort of being the most prevalent or most aggressive on it. And the convenience rule says, look, if you're working from home for your own convenience and not because your employer told you to go work in that state, then we're going to still tax you on those work days. Again, it was an issue in New York going back decades, not really so much in the other states, but it was an issue, not the biggest issue we ever had to deal with. It was, maybe a half of a PowerPoint slide at the end of one of our residency presentations, right? It wasn't a huge issue. But of course, now with everyone working remotely, or so many people still working remotely, not just during COVID, but maybe continuing, it's a huge issue. And New York literally can't afford to lose all that revenue. So New York came out shortly, in the summer of 2020 and said, look, even if your office closed in New York, if you're telecommuting into New York, we're still going to tax you, right? We're still going to impose tax on your compensation, even though you're not physically here. So the typical example is someone said, oh, I'm moving to Florida. I'm going to save all these taxes. I'm getting rid of my New York home. I'm getting a place in Florida. And it's awesome because my employer is like, look, we don't care where you work. You can work wherever the hell you want. Great. So I moved to Florida and now I just save, 6, 7, 8%, 9%, whatever on all my compensation. Hold up. New York's going to say, well, wait a minute. If you're just working from home for your New York employer, we still get to tax you. So that's a problem. I mean, there's ways around this and sort of listed here on this slide. I mean, we could open up a real office for that person in Florida and that person can work in that office. There's no telecommuting problem there because they ain't telecommuting. They're working from an office, right? We could assign them to a different office of the employer. You got to be careful there. It can't be fake, right? They have to have some reason to be assigned to the Tampa office. They have to go to the Tampa office. I mean, maybe not every day, but they got to go there sometimes. What we're trying to establish in option 1 and option 2 here is that the new office is this person's primary office, right? So that the days worked at home get sourced to the primary office, not to the office in New York. And of course, any days worked in that office are clearly not convenience days because you're sitting in an office. So you can set up an office in a state to maybe get around this. If you never go to New York, like never ever for one day, well, then you're also okay. Then that's not, the convenience rule can't apply to you. So there's an old case that says that. I think New York's going to have to respect that old case, but that's a way around this. And then there's you can set up what's called a bona fide employer office. That's a sort of a term of art in New York. If you have a bona fide employer office in your home state, then days worked at home will count as days worked out of state. Here on the slide are sort of the bona fide employer office factors. You have to meet 4 of the 6 factors on the left side and 3 of the 10 factors on the right side. It's a little bit of a laundry list of factors you have to meet. You have to be deliberate about it. We've worked with clients on setting up telecommuting agreements or telecommuting arrangements designed to meet these factors. The point is there's a way to fix it. It's a way to manage it if you're deliberate about it. If you're not deliberate about it and someone just moves to Florida and thinks they're saving all this money, they probably aren't. And then lastly, here, guys, just to put it on your radar screen, on a multi-state basis, this was a big issue again with everyone working in different states. Lots of states came out and said, hey, you know what? We're going to do like New York did and do like a convenience rule and say, hey, we're going to tax you based on where your office was, even if you left the state temporarily during COVID. Massachusetts was one of those states. New Hampshire didn't like that because lots of New Hampshire residents weren't going into Boston anymore to work. and New Hampshire sued Massachusetts. The Supreme Court could have taken the case, but they didn't. So, it was just sort of a hodgepodge. In fact, on this slide here, you see some states said source it to the employer state. Some states said source it to where the employee's home state is. A real hodgepodge. A lot of this stuff has expired, but just to sort of a heads up that on a multi-state basis, this became a real big problem as well. All right, guys, quick hitter, half hour, love it, good stuff. So if you have any questions, my contact information is there. Again, feel free to shoot me an email, and I guess I'll see you all next year.
Great, thank you so much, Tim. If anyone has any specific questions, new business opportunities, any other issues they'd like to discuss, please feel free to reach out directly to Tim or myself where appropriate, and I'll be sure to include his contact information in the follow-up email to this program. As I mentioned at the onset, the goal of these programs is to stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. Two more quick items before I let you go. First, my next program will be on Thursday, May 12th, and is entitled Estate Planning for Cryptocurrency and NFTs, featuring Lara Sass, founder of Lara Sass and Associates, based in New York City. Second, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees. I thank you in advance for that. And with that, this concludes today's session. Please stay safe, healthy, and have a wonderful day, everybody.